Today, I want to talk about how billionaires like Bill Gates, other hedge fund managers, and even politicians are selling their shares, preparing for a giant market crash and credit event. So stay tuned and let's make some money. So I want to dive straight in with the key information. So, Buy the Crypto Dip tweeted saying Bill Gates has sold every position. Billionaires don't sell positions in volumes like this unless the market is about to crash. So we can see Bill Gates has sold his entire shareholdings in Apple, in Meta, in Adobe, in Amazon, and many other companies. He's trimmed positions in Microsoft and Berkshire Hathaway, but has sold everything else. He's sold 100% of his shareholdings in JP Morgan, in Google, in Oracle, Pfizer, and as I said, everything else he held. He's sold over 14,000 Google shares, over 14,000 Visa shares, over 68,000 Pfizer shares, and many others. And crazily enough, he even sold 2.6 million Berkshire Hathaway shares and obviously 1 million Microsoft shares too. As Buy the Crypto Dip said, billionaires don't sell positions in this kind of volume unless they're preparing for a massive market crash. But as I said, Bill Gates isn't the only one, because here's Republican Senator Tommy Tuberville, who's been selling extensively. Tommy Tuberville has again sold thousands of shares in Meta. He's sold 375,000 shares of Apple, another 8,000 shares of Adobe, and many others. You can see every single one of these transactions is a sell transaction other than this one transaction here, which is to buy new put options, aka betting the PG or Procter & Gamble stock will fall. This again shows Tommy Tuberville is doing the exact same thing Bill Gates is doing and selling everything. And you may have also seen the other day Jeff Bezos sold off another $2 billion worth of Amazon stock, now with a total of $6 billion of shares sold over the last week. Yes, that's right, Jeff Bezos has sold over $6 billion worth of Amazon in one singular week. That's not a few $100,000 worth of shares sold, not a few million worth, not even a few 100 million worth, but $6 billion worth. And that's not even $6 billion worth of shares sold over 5 years, over 10 years, over 1 year, but sold over one single week. And that's because systemic risk concerns are growing amongst money managers and hedge funds as the real estate woes continue to cause turmoil. It says the US commercial real estate and Chinese real estate are the most likely sources of a massive credit event. On top of that, the latest inflation figures, because inflation is now back on the rise, have a lowered likelihood or the likelihood of rate cuts. Also guys, today we ended up going 2 for 2 profitable trades in the Millionaire Mindset trading group, as well as some other profitable options trades and profitable longer term trades too. The first trade was on MEDS, which I alerted telling everyone that I was buying at 11:59 AM GMT time in the pre-market. You can see that's on this big green candle here as it was just breaking out of its previous highs and continued running for a 36% gain. Trepidoodle and Bilbo grabbed 15% each and Firefly also took a 12% gain too. The second trade was on C-Pop where Freakdeline made a whopping 35% gains, buying in at $6.14 and selling at $8.29. The Millionaire Mindset Trading Group is now over 450 members strong, and we've got a range of fast-moving momentum news plays, options trades, and even longer-term trades too. So guys, be sure to join the group using the link in the description below. It says fears of a systemic credit event are growing amongst fund managers as alarms sound in the property market or in property markets around the world. It says hopes the Federal Reserve would cut interest rates and alleviate some of the pressure on real estate were dented by stronger than expected inflation numbers this week. And meanwhile, more than $900 billion of debt on US commercial and multifamily real estate will require refinancing this year, a 40% jump from an earlier estimate. And potentially most worryingly of all is that smaller banks seem to be on a trajectory towards 8 to 10% default rates in their commercial real estate loan books. There's a scene from the film The Big Short where Mark Baum goes to that convention and says that with default rates over either 5% or 7% would cause absolute turmoil. And right now, 8 to 10% default rates are expected. So if 5 to 7% caused the 2008 recession, what on earth will 8 to 10% cause? And the paper warns the commercial real estate distress could leave more than 300, mainly smaller regional banks, at risk of solvency runs. Okay, so these hedge funds are confirming what I've been saying for weeks now, which is that there are indeed going to be more bank runs. They're predicting 300 individual banks experiencing bank runs. And it says, for now, the Fed is coordinating with lenders with concentrated commercial real estate exposure on a plan to work through the expected losses. Does that mean the Fed is currently creating another bailout plan? That's yet to be seen. Either way, it will be very interesting to see exactly what happens over the next few weeks and the next few months, and how many banks or how many more banks we see collapsing. And it'll also be interesting to see if interest rates are hiked further to bring down inflation, how much damage that would actually cause. Now, Sven has also pointed out something very interesting with the Fed and how they talk about soft landings. You can see the Fed is talking about how a soft landing is all but confirmed in 2024, and how the Fed also confirmed a soft landing in 2007, and again how the Fed confirmed a soft landing in the year 2000. Now, what's interesting is this soft landing in 2000 led to a stock market crash. This soft landing in 2007, a stock market crash, and this soft landing in 2023, 2024 will likely end in the same result, which is another stock market crash. Unless, of course, even though this has happened multiple times before, this time might be different. The reason why I say that with hyphenated quotes is because each time somebody says, guys, surely this time is different, it typically turns out not to be different. The composer has also pointed out, saying the top 10 stocks in the S&P 500 now account for over 32% of the entire index. During the dot-com bubble, it was 25%. Again, as Inverse Cramer pointed out, he said, yeah, but surely this time is different, right? But again, as I said, typically when people are thinking, surely this time is different, it turns out not to be different at all. Especially as US banks currently hold about $2.7 trillion in commercial real estate loans, and 80% of which are held by smaller regional banks. And more than $2.2 trillion in loans will come due between now and the end of 2027. So that's a massive amount in commercial real estate loans, which are potentially on the cusp of defaulting and will also need refinancing over the next few years at significantly higher interest rates. Especially when interest rates are now looking like they may need hiking further to bring down inflation and not being cut. Which, as I said earlier, would cause massive distress on these regional banks, massive distress on the entire banking sector, and likely a credit event. Especially as Biggums has tweeted, a review by Bloomberg found that 22 banks with $10 billion to $100 billion of assets hold commercial property loans 3 times greater than their entire share capital. Okay, even just a small increase in the default rates of these giant commercial property portfolios would destroy many commercial banks or many regional banks, especially as that figure was even higher among banks with less than $10 billion in assets. This is starting to look ever more likely that we're going to see more and more regional banks failing and the commercial real estate market sector imploding even further. Again, causing a feedback loop of failing banks, failing loans, more failing banks, and more failing loans. And finally, as unusual, Wells has tweeted, investments in new hedge funds in 2023 fell to new lows, while established hedge funds hiked fees to the highest on record. This suggesting regular investors are starting to wise up to these hedge fund tricks, how much money those investors are losing to fees, and how much money those investors are losing in the markets. Because of how much outsized risk these hedge funds are taking, losing investor capital. So it seems like the era of hedge funds ruling the market will soon be over. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.